Hello everyone, welcome back. So now let's revise valuation. Now, first of all, valuation provisions is given in section 15 of CGST Act 2017. Now, valuation provides for transaction value because under GST everything is based on ad valorem. Ad valorem meaning value. On the value, a percentage of tax will be applied and the tax will be paid. Transaction value is defined as the price actually paid or payable for the supply. And transaction value is accepted only when two conditions are satisfied. First, price is the sole consideration. That means you are not receiving anything in addition to the price. Sir, what if we receive anything other than the price? Then the value will be based on valuation rules. And the second one is supplier and recipient are not related persons, because the moment they are related persons the price might get influenced, and hence government says transaction value will not be applicable in case of related person transactions. Then how will we determine the value? As per valuation rules. Then the law has some inclusions and has some exclusions. Certain things are included in value and certain things are excluded from value. For example, any tax other than GST and compensation cess. GST and compensation cess are excluded. Other than that, any tax which is collected will form part of value. CBIC has clarified that TCS, which is collected under Income Tax Act 1961, will not form part of value, because TCS is as good as a income tax paid in advance, and it doesn't make sense to levy GST on income tax paid in advance. Then the law talks about incidental or ancillary charges. Any incidental or ancillary charges will also form part of value. For example, transportation charges, packing charges, installation charges, this will also form part of value. Then we have third party payment. Third party payment which is made by recipient on behalf of supplier. On behalf of supplier. So third party payment made by the recipient on behalf of supplier. Say suppose supplier says that you need to pay additional 2000 rupees to some other person, then that additional 2000 which the recipient is paying to some other person is as good as payment made to the supplier, and hence it will form part of value. Then the law talks about any subsidy other than government subsidy. So government subsidy is excluded, but be careful, the subsidy which we are talking about should be directly linked to the price. Only when it is directly linked to the price, only then it will be liable. What do you mean by directly linked to the price? There is a direct relation between the price of the goods or services being charged and the subsidy which is being given. Say suppose for coaching classes the fees is 70,000, 5,000 is being paid by Infosys, 65,000 student is paying. This 5,000 which Infosys is paying is directly linked to the price of the coaching class of one student. This is directly linked, and hence it will form part of value. If it was not directly linked, then in that case it will not be liable. Government subsidy, it doesn't matter whether it is directly linked or not directly linked. Anyways, it will not be liable. Then interest. Interest on delayed payment of consideration for a taxable supply. So if the underlying supply is taxable, then interest on that will also be liable to GST, for a simple reason that government is very clear. If main supply is taxable, then interest will also be liable to GST. There will be no benefit which will be given for interest. Then the law says pre-supply discount will be excluded. Which pre-supply discount, sir? Pre-supply discount is discount given before the supply. It will be excluded provided it is recorded on the invoice, that is shown on the invoice. It should be shown on the invoice that this is the discount which is being offered, and the moment it is shown on the invoice, it will not form part of value. Then post supply discount. See, post supply discount will not be liable only if two conditions are satisfied. First, it should be known at the time of supply. That means there should be an agreement at the time of supply that in future you can get this discount. Second, ITC should be reversed by recipient. ITC should be reversed by recipient, because if supplier wants to reduce his output, think if supplier wants to reduce his output because he is offering a discount. See, when he makes a sale, he will charge GST on the full amount. Now when he is offering a discount, basically he wants to reduce his value, so he will issue a credit note. When the supplier is issuing a credit note, recipient will have to record that credit note and reverse ITC correspondingly. Only then the supplier will be able to reduce his output. Then any material which is given free of cost by recipient, which was obligation of supplier, and it is obvious, say suppose something was obligation of the supplier, then supplier should have taken care of it. Now something which is obligation of the supplier and recipient is giving it free of cost, that means it is as good as additional consideration which is flowing to the supplier, and hence it will be liable to GST, will form part of value. Now in this entire inclusion exclusions, there can be two types of questions which are asked. One is a all inclusive question, where all these are already included in the question price. Say suppose 7 lakh is given. This 7 lakh already includes everything. It has the main price of the product. The inclusions are also included. Exclusions have not been removed. GST have not been removed. So these two are not removed. Now what will you do in this case? Sir, we will remove these two. Once we remove these two, we will get the price. Now which one will you remove first? Will you first remove the exclusion or first you will remove the GST? Always when an all inclusive question with GST is given, first you remove the exclusions and then remove GST. Why? So that you remove GST only on the transaction value which is actually subject to GST. If you first remove GST, because GST will be given as a percentage, if you first remove GST, you are actually removing GST on the exclusions, but exclusions there wouldn't be any GST at all, and that's why first remove the exclusions, then remove GST. Also be very careful whether all these points have been considered or not considered. Say suppose subsidy is already considered, then if it's a government subsidy and it is already considered, you have already deducted it, don't deduct it again. If other subsidy is already considered, that means you have deducted it, then add it back so that it can be made liable to GST. So be careful of the wordings which are given in the question. When the question says net of subsidy, that means it is already reduced. When the question says already included, included meaning it is already there, till now subsidy has not been reduced. So you know the taxability very well. Based on the taxability, read the English properly to arrive at a answer. This is the first type. Second is when the price is given and adjustments are given. Price with adjustments. Now adjustments, you'll have to adopt to each adjustment. Whatever is to be included, whatever is to be excluded, whatever is already excluded, don't exclude again. That is the basic fundamental principle which you will adopt. Then coming to the rules, say you have rule 27 to 35 which deals with valuation. Rule 27 talks about consideration not wholly in money. Now when consideration is not wholly in money, how will the value be derived? The first point is use open market value. Open market value is to be used. What is open market value? The price at which you normally sell it when supplier and recipient are not related and price is the sole consideration. At or about the same time, the price at which you are selling. So suppose this is not available, then you will use monetary plus non-monetary in money. Third one, like, kind and quality. Like, kind and quality. Fourth one, cost plus 10%, which is rule 30. And last one, reasonable means. Now the law provides an option for service industry. Service industry can use 5 before 4. Sir, why are you saying can use 5 before 4? That means, is there an order? Yeah, there's an order. First you can always use open market value, only then you can use money plus non-monetary consideration converted in money. If OMV is available, then you will not even touch the second point, because all these have to be followed in a order 1 2 3 4 5. The sequencing cannot be changed. Then we have rule 28. Now rule 28 talks about related person other than agent. Other than agent meaning other than schedule 1 agent. Now related person or distinct person, the valuation will be first one, you'll go by open market value. Second one, this monetary plus non-monetary in money is not there. Third, like, kind and quality. That means the second method is like, kind and quality products and its valuation. Then you have cost plus 10%, which is as per rule 30. And then you have reasonable means, which comes from rule 31. So this is the order. Now rule 28 has undergone changes plus some very important points. Now say suppose, and the same thing is applicable here as well as here. Now rule 28 has various special points. For instance, supplier has an option that he can use 90% of the sale price of recipient if the same product is being sold and it should be supplied in the same form. There should not be any changes which are done to the product. Then at the option of the supplier, he can either use open market value or like, kind and quality, whichever is available, and compare it with 90% of the sale price of the recipient to unrelated persons. Second, the law says if the recipient can avail full ITC on the transaction, then invoice value is deemed to be open market value. Invoice value is deemed to be open market value. Thereafter, let's talk about personal guarantee. See, a director can give a personal guarantee for the loans taken by a company. CBIC has clarified that personal guarantee consideration cannot be charged as per RBI regulations. a director cannot charge consideration. Now when we say a director cannot charge consideration, the open market value becomes 0. It is a supply, but the OMV is 0. Though being a supply, OMV is 0, and hence the GST will be 0. But what if, sir, even if he was not allowed to be charging anything, if he has still charged, then whether GST will apply on that? Obviously yes. Even if it is illegal, if you start charging something from the company as a personal guarantor to the company, then GST will apply on that consideration. Second part is corporate guarantee. Now what happens in corporate guarantee? Corporate guarantee, one company is giving guarantee to another company, holding company giving guarantee to subsidiary company. Then the value will be 1% of guaranteed amount per annum. Careful, per annum, or actual consideration, whichever is higher. This is the valuation mechanism provided for corporate guarantee. Now, there were a lot of issues which were faced by the trade. First, remember one thing, this provision is applicable only when supplier, that is the guarantor, is giving guarantee to recipient who is located in India. So recipient has to be in India, only then this provision will trigger. Sir, what if recipient is outside India? This provision will not trigger. Supplier can be anywhere. Sir, what if the supplier is outside India? If supplier is outside India, then recipient will have to pay the tax under RCM. If supplier is in India, then it will be a case of forward charge. Now, if supplier is outside India, then taxable under RCM. If supplier is in India, then taxable under forward charge. Plus, for this valuation, government has said if recipient can avail full ITC, then invoice value, or I'll just write value declared on the invoice. Value declared on the invoice will be accepted. That means if recipient can take full ITC, you don't have to worry at all even about corporate guarantee, because at the end of the day it is revenue neutral. One person will discharge output, one person will get ITC. Net effect of the transaction is 0. So this is the law. Now some clarifications which have been given for this. Say suppose two people giving guarantee, then you will have to do proportionate calculation. Second, say suppose the recipient is outside India, then no GST. Can I say not covered by Rule 28? You can go by the normal provisions, but it is not covered by Rule 28. Then what about a case where full ITC available? Then value declared on invoice. Last important one, say suppose loan versus guaranteed amount. Can there be a difference? Yes. Now it is so possible that guarantee is given for 5 crore, but loan taken is only 1 crore. So it will be on the guaranteed amount. It will not just be on loan which is disbursed. Sir, what if the loss is per annum? Say suppose it is for 5-year guarantee, then multiply it. Per annum 1%, 5-year guarantee, 5 year into 1% comes to 5% of the amount, that is the value of the supply. Sir, what is if it is for half year? Then proportionate. That's obvious, it works both sides. Now this is something which is very important, you can get a question on this, but beware, now the provision is lighter, because if full ITC can be taken by the recipient, then the value which is declared on the invoice will be accepted as the value for the transaction. So this was about rule 28. Then you have rule 29, which talks about agent. CBIC has clarified that whenever we use agent in all these provisions, we are actually referring to the supplier and recipient being the schedule 1 transaction. Do you recall schedule 1 transaction? Yes, that's what we are talking about. Now here you have a choice, either open market value or 90% of the price at which agent is making a supply. Agent is making a supply. Sir, if these are not available, then obviously you have rule 30 or rule 31, and this is to be used only in this order, because this deals only with goods, because schedule 1 covers only goods transaction between principal and agent, where the agent is billing in his own name. Rule 30 and 31 we have already learnt. Now coming to the next segment. The next segment is rule 32. Rule 32 again provides for valuation mechanisms. See, central government has a power that they can determine valuation for certain transactions as per their discretion. Using these, they have determined it under rule 32. Rule 32, the first sector is air travel agent. Now air travel agent, the value will be, for domestic bookings it will be 5% of basic fare, and basic fare is the fare on which commission is generally paid to the insurance agent. International bookings it will be 10% of the basic fare. This is the first one. The second one is relating to insurance sector, and specifically we are talking about life insurance. Now for life insurance sector, the law has said, say suppose it's a risk based policy. Then the value will be total premium charged. Whatever is the premium charged, that will be considered as value. If it is investment based policies, where some amount is invested and some amount is used towards risk, that is life coverage, then should the entire amount be liable? The answer is no. For investment based policies, they have said if breakup is informed to policyholder while issuing the policy, then you have the breakup, risk portion liable to GST and investment portion no GST, because you already have the breakup. Sir, what if the breakup was not informed? If breakup was not informed, then in that case, first year premium value equals to 25% of premium charged, because first year the service is more, so 25% of the premium charge. Subsequent year, see, we have to just take the check, deposit it, and it becomes very, very simple. So subsequent year value will be 12.5% of the premium charged. 12.5% of the premium charged. And the law also provides that if it is a single premium annuity policy, then value will be 10% of premium charged. 10% of the premium charged. This is the second one. Then the third one in this is money changing services. Now what's money changing services? Exchange of foreign currency. Now money changing services, the law has said that the value will be dependent on two basic factors. So you have two methods which have been prescribed by government. The first method is where RBI rates are available, and second method is slab rates. Now when RBI rates is available, if one currency is INR and RBI rates is available. Which RBI rates? Reference rates. Then value will be difference between RBI rate and transaction rate into number of units. RBI rate and transaction rate into number of units. Sir, say suppose this is not available. Now if it is not available, then if RBI rate is not available, then in that case 1% of amount exchanged. And if none of the currencies is INR, then 1% in lower of the both in INR. So basically we are using 1%, but we'll use lower of both the currencies in INR and lower amount will be used. So these are the three methods which are there in RBI rate. Then you have slab rates. Second method is slab rates. Slab rates, if the amount exchanged is 0 to 1 lakh, then 1% of amount exchanged and minimum is 250. If it is 1 lakh to 10 lakh, then 0.5%. First I am just writing 1000 is because first 1 lakh into 1000, 1 lakh into 1% will be 1000 plus 0.5% of amount in excess of 1 lakh, and lastly if it is more than 10 lakh then 5500. How did we get this 5500, sir? 5500 is when you compute this entirely for 10 lakh. So compute this entirely for 10 lakh, 1000 plus 0.5% into 9 lakh. 0.5% into 9 lakh is 4500. 4500 plus 1000, 5500 plus 0.1% of the amount in excess of 10 lakh, and maximum is 60,000. So they have set up a maximum also, which is a very good thing. So this is when it comes to slab rates. So first we learnt about air travel agent, then we spoke about life insurance sector, then we spoke about money changing services. Then you have one last point in this, which is margin scheme. Margin scheme is where you are dealing with second hand goods, dealer of second hand goods. Now dealer of second hand goods, the law has said that the value will be sale price minus purchase price. Sale price minus purchase price, because it's already second hand goods. Whatever is the purchase price, on that we don't want tax. Only on the margin, that is difference between sale price and purchase price, that's what we need GST with. But there are conditions. No ITC available on the purchase of goods. If it is negative, then in that case it will be 0. Third one, only minor processing allowed. If there is any major processing, then in that case it will not be allowed. Plus, the law also says that in case there is sale of repossessed goods by banks, what happens in repossessed goods? Say suppose I bought a car, then I was not able to pay the EMIs. The bank will take away the car. Now they will take away the car and sell it. So what will be the value for those repossessed goods? For repossessed goods, the value will be sale price minus purchase price of original buyer. Purchase price of original buyer minus 5% per quarter or part of quarter from date of purchase till date of sale. Till date of sale. This is how the computation is to be carried out for repossessed goods. Now coming to motor vehicle, there is a rate notification, but that rate notification also provides one valuation mechanism. That valuation mechanism is kept in your syllabus. Now motor vehicle, say suppose you are selling a motor vehicle. If you have availed ITC, like truck you can avail ITC, then pay GST on sale price, and then you will compare it with ITC availed minus 5% per quarter or part of the quarter, whichever is higher. Where is this, sir? This is there in ITC. ITC says that if you are selling any goods, then you have to do it this way: tax on transaction value or ITC availed minus 5% per quarter or part of the quarter. If you have not availed ITC, no ITC availed. If you have not availed ITC, then have you claimed depreciation under section 32 of Income Tax Act? If you have claimed depreciation under section 32 of Income Tax Act, then in that case value will be sale price minus depreciated value under section 32. Otherwise, if you have not claimed depreciation, then it will be sale price minus purchase price. So be careful of this. This comes from a rate notification, but institute has kept it in your module, so you should know this very well. Then vouchers, the value will be redemption value and not the value at which you had bought them. So say suppose the face value is 1000, then the value will be full 1000. That is what is given in rule 32. Then let's talk about rule 31A. What is rule 31A, sir? Rule 31A talks about valuation of two things: lottery, and second one is betting, gambling and horse race. Now betting, gambling and horse race, value equals to 100% of bet, while lottery, the value is face value into 100 divided by 128 or price notified into 100 by 128, whichever is higher. That means lottery, government is treating it as inclusive of GST, because value will be considered inclusive of GST. Rate of GST is 28%, they are considering it as inclusive of GST. But betting, gambling, horse race will never be considered as inclusive of GST. Then rule 31B and 31C have given valuation for casinos and online money gaming, which I will discuss separately in a revision video of online money gaming, which will cover the entire ambit of online money gaming. Then coming to rule 33, which talks about pure agent. Now say suppose you receive a reimbursement, whether GST will apply on that reimbursement which is received by the supplier, because normally when we are charging for any service, we also include something called as reimbursement. Big Four people understand this as out of pocket expenses. So reimbursement, 1 lakh invoice, 5,000 reimbursement for some expenditures which are incurred. The question is, when this reimbursement is received, whether GST will apply. See, two types. When reimbursement is used by the supplier to provide the service. If reimbursement is used by the supplier to provide the service, then in that case liable to GST, because he is using it, like accommodation reimbursement, travel reimbursement, all these are used by the supplier, that will be liable. If reimbursement is incurred as a pure agent, reimbursement incurred as a pure agent, if reimbursement is incurred as a pure agent, then no GST is applicable. If 7 conditions are satisfied. If 7 conditions are satisfied. Now what are those 7 conditions, sir? First one, you should be a pure agent. Pure agent, to become a pure agent, you have 4 conditions. So that taken together is 7. Second, actual amount charged. Then providing it additionally than the main service. See, main service is something else. This reimbursement, it's just additional to whatever was there, separately indicated. indicated on invoice, then does not use it. Recipient should not use it. Neither holds title nor intends to hold. And last one, it should be part of the agreement. If all these 7 conditions are satisfied, then that reimbursement will not be liable to GST. Then you have Rule 34. Rule 34 talks about exchange rate. Which exchange rate should be used to convert foreign currency into INR? Rule 34 saying that if it is goods related transaction, then CBIC rate on the TOS, time of supply. Whatever is the time of supply, based on that use CBIC rate. For services, it is the rate as per GAAP, generally accepted accounting principles, on the TOS for services. So for goods you use TOS for goods, for services you use the date, which is the TOS. Then you have Rule 35. Now what does Rule 35 say? Rule 35 says value will be, amount will be inclusive of GST is if GST is not charged or collected separately. If you don't charge or collect GST separately, then in that case, whatever is the amount charged, that amount will be considered as inclusive of GST. So this is the rules. There are some important clarifications. First one is OEMs. Now, original equipment manufacturers supply molds free to the manufacturers. The question is whether they should charge GST when they are supplying these free of cost to the manufacturers. OEM, original equipment manufacturers. Then these manufacturers are component manufacturers who are making some components. Like Tata will be the OEM, some component manufacturers, some will make doors, some will make screws which are to be empaneled. All those are component manufacturers. So molds will be given free of cost by the OEM, whether GST will apply. Now if it was obligation of the recipient, because he is the recipient, he is the supplier, if it was obligation of the recipient, then in that case no GST. If it was obligation of the supplier, then in that case GST will be applicable. Plus, is OEM required to reverse ITC? The answer is no. That's clearly given in the law. Then coming to airport levies. Now there are some airport levies which are collected by flight operators. Airport levies which are collected by flight operators, whether GST will apply on airport levies which are collected on behalf of Airport Authority of India or private airports by flights like airline companies. The answer is no, GST will not apply, because airport levies, the liability to discharge GST is on airport operators and not on flight operators. Flight operators are only acting as a pure agent when they are collecting it on behalf of the airport authorities. But flight operators also charge some 5 rupees as convenience fee for this. Whether GST will apply on that? The answer is obviously Yes. Then there is one important circular with regard to import of service. Now, import of service, what will be the value for import of service between related persons? You will go by Rule 28. And if recipient can take full ITC, then open market value is then value declared on invoice is deemed to be open market value. So this is what is specified under valuation. You need to be very smart with regard to valuation because it will be included in some or the other question here and there. Let's quickly go through what all we have seen. Let's do a sum up of what we have seen in this. So we started with valuation. That valuation is covered by section 15. Valuation will be based on transaction value. Transaction value is the price actually paid or payable for the supply. Then transaction value will be accepted when two conditions are satisfied. Which are the two conditions? First, price is the sole consideration. Second, supplier and recipient are not related persons. Inclusions, any tax other than GST is included. Incidental charges are included. TCS will not be included. Third party payment included. Something given free of cost by the recipient which was obligation of the supplier will be included. Subsidy will be included. Government subsidy will be excluded, but only about directly linked to the price. Interest on delayed payment will be included. Pre-supply discount excluded. Post-supply discount is excluded first when it is known at the time of supply, and ITC is reversed by the recipient. Only when these two conditions are satisfied, then post-supply known, it will be subtracted. Two types of inclusive question is given. Now if all inclusive question is given, then in that case you will go by that all inclusive part. If there is a price adjustment and with price all the adjustments are given, then do the additions and exclusions as you have learnt. First, always remove the exclusions, only then remove GST to arrive at transaction value. Then we moved on to the rules. Rule 27, 28, 29. 27, first it says open market value. If that is not available, money plus non-monetary in money. If that is not available, like, kind and quality, cost plus 10% reasonable means. Services can follow 5 before 4. Rule 28, related person, OMV, like, kind or quality, cost plus 10% reasonable means. Two important points: 90% of sale price can be used as the value for this transaction. And second is, if recipient can avail full ITC, whatever you have mentioned in invoice, that is deemed to be open market value. Rule 29, agent only for goods, OMV or 90%. If that is not available, 30 and 31 is common. Now rule 28 has some very important points. Personal guarantee, there can anyways be no GST because it's a supply between related persons, but as RBI has said, you cannot charge, open market value is 0. Corporate guarantee, 1% of the guaranteed amount per annum or actual consideration, whichever is higher. Supplier can be anywhere, recipient should be located in India, only then this provision will get triggered. So you need to be careful about this one particular point. If supplier is outside India, taxable under RCM. If supplier is in India, taxable under forward charge. If recipient can take full ITC, then whatever is declared is accepted. If two people are there giving guarantee, proportionate 1% with actual consideration of both have to be compared. Recipient outside India, it's not covered by rule 28. If you can take full ITC, that's known. Loan, guaranteed amount. Be careful with per annum. If it's a 5-year guarantee, for all 5 years you will have to pay today time of supply will arise today. Rule 32, various points. Air travel agent, you go by domestic bookings 5%, international bookings 10% of basic fare. Life insurance sector, you can have risk-based policies or investment-based policies. Risk-based policies, whatever premium you have charged. Investment-based policies, breakup available, risk portion will be liable. If breakup is not available, first year 25%, second year and subsequent year 12.5%, single premium annuity policy 10%. Money changing services, RBI rate is one method where RBI reference rate is available. Second is slab rates. RBI reference rate, be careful. If one of the currencies is INR and RBI reference rate is available, difference between RBI reference rate and transaction rate into number of units. If no RBI rate is available, 1% of the amount exchanged. None of the currencies is INR, convert both into INR and lower of the two into 1%. Slab rates 0 to 1 lakh, 1% is used, minimum 250. 1 lakh to 10 lakh 0.5%, and you don't forget to add 1000 initially. More than 10 lakh 5500 plus 0.1%, maximum 60,000. Then margin scheme, be very careful. Margin scheme is for second hand goods dealer. Sale price minus purchase price, but you cannot avail ITC. Negative 0, only minor processing is allowed. Repossessed goods, same conditions are there, but sale price minus purchase price of original buyer minus 5% per quarter or part of the quarter from the date of purchase till date of sale. Motor vehicle, if ITC is availed, go by the. If ITC is not availed, then in that case, depreciation under section 32 claimed, sale price minus depreciated value, otherwise sale price minus purchase price. Rule 31A, lottery inclusive, but betting, gambling and horse racing 100% of the bet amount. Pure agent reimbursement, if it is used by the supplier, liable. If it is incurred as a pure agent, all conditions satisfied, then it will not be liable to GST. You should only charge the actual amount. You should provide it in addition to the main service which you are providing, meaning reimbursement is only incidental. Separately indicated, reimbursement should be separately indicated. You should not use it, you should not hold the title, it should be as per agreement. Exchange rate for goods, CBIC rate for services, generally accepted accounting principles. Rule 35, amount will be considered as inclusive of GST if you have not collected or not charged GST. OEM circular, be very careful, free provided. If it was obligation of recipient, no GST. If it was obligation of the supplier, it's an additional consideration to the supplier. Airport levies, GST will be paid by the airport operators. Commission charge, GST has to be charged. Import of service from a related person, Rule 28, recipient can avail full ITC, then whatever you have declared on the invoice is deemed to be open market value. See you in the next video.